Are you looking for a way to pay less taxes while keeping and growing more of your own wealth? Today we explore two investment options: tax-free savings accounts or TFSAs and whole life insurance. Both offer tax benefits but cater to different financial goals. So let's dive into how they work and which one might be a good fit for you. I'm Rozdeba, the CEO of Dundas Life, and I've been in the life insurance industry for over a decade. Dundas Life is dedicated to empowering Canadians on their journey to financial security, helping hundreds of individuals and families just like yours navigate the complexities of personal finance. So what's the difference between life insurance and a TFSA? Over the next few minutes, we'll break down the pros and cons of each strategy. By the end of this video, you'll have a complete understanding of how a TFSA and life insurance policy can fit into your overall financial plan. But before we jump in, don't forget to smash that like button and subscribe to our channel today. Have you considered how tax-free growth could help you reach your financial goals faster? A TFSA or tax-free savings account is a Canadian savings account that allows you to deposit money, invest it, and have those investments grow tax-free. Tax-free savings accounts have become a favorite among Canadians for their simplicity and flexibility, especially when it comes to saving for retirement, purchasing a first home, or a dream vacation. Here's how the TFSA works. A TFSA allows for tax-free growth on your investments, meaning that any interest, dividend, or capital gains earned within the account are not subject to tax, even when you withdraw them. However, contributions to a TFSA aren't tax deductible, which is something to consider when planning your saving strategy. Another aspect to keep in mind is the contribution limit. In 2025, the annual contribution limit is $7,000 and $7,500 in 2026. Any unused room can be carried forward. While this is great for everyday savers, it can be a limitation for those looking to invest more than $7,000 per year. It's also important to be mindful of the TFSA's withdrawal rules. Any money you withdraw from your TFSA will reduce the available contribution room you have that year. While you can recontribute the withdrawn amount in the following year, this can impact your overall strategy if you anticipate needing frequent access to your funds. For example, if you're saving for a down payment on a house and plan to withdraw the funds within a year or two, a TFSA might be a suitable option. However, if you're investing for the longer term, like retirement, the impact of withdrawals on contribution room becomes less of a concern. Finally, TFSAs do have some drawbacks. The main one is its contribution limit. You can only contribute a certain amount to a TFSA each year. If you over-contribute, you may be subject to penalties. But don't let contribution limits deter you. TFSAs remain one of the most flexible tools for short-term and mid-term financial goals. Additionally, TFSAs are subject to market fluctuations, which can impact the value of your investment. Now, let's explore a less common but incredibly popular wealth-building strategy: whole life insurance. But before we dive in, we'll explain the difference between whole life and term life insurance. Term life insurance provides coverage for a specific period, typically 10, 20, or 30 years. Whole life insurance, on the other hand, offers lifelong coverage and a cash value component that grows tax deferred. This means you won't pay taxes on the growth of your cash value until you access it, either through withdrawals or policy loans. This tax-deferred growth can be a significant advantage, particularly for high-income earners. Since whole life is more similar to a TFSA, we'll focus on this type of life insurance in this video. One of the key benefits of whole life insurance is that it provides a guaranteed minimum return on your cash value. This means that you can be confident that your money will grow over time, regardless of what happens in the market. Additionally, whole life insurance policies often come with a dividend payment, which can provide you with additional source of income, especially in retirement. Dividend payments are paid out to policyholders based on the performance of the insurance company. For example, let's say you have a whole life insurance policy with a dividend payment of 5% per year. Over the course of 20 years, that dividend payment can add up to a significant amount. Using whole life insurance as an investment is not without its complexities. It requires long-term commitment, and the policy structure is more complicated than investing in a TFSA. There's also the potential for conflicts of interest, as some insurance advisors may be incentivized to recommend policies that maximize their commission rather than your best interest. At Dundas Life, we're committed to transparency. working closely with you to develop a personalized strategy that aligns with your specific financial goals. So, who is the ideal candidate for a whole life insurance strategy? To start, high income earners who have maxed out their contributions to other registered accounts such as TFSAs and RSPs often find whole life insurance to be a valuable addition to their overall financial plan. That's why whole life is often called the bottomless TFSA, since it has no maximum contribution limit. It's also a powerful tool for business owners seeking asset protection and succession planning. With a properly structured whole life insurance policy, you can withdraw money from your corporation at a lower effective tax rate compared to paying salary or dividends. This especially makes sense if you have stable cash flows from your business. However, whole life insurance is not suitable for everyone. If you're just starting out on your investment journey or have limited financial resources, other options like TFSAs or RRSPs may be more appropriate. It's important to remember that TFSAs and whole life insurance are just two pieces of a larger financial puzzle. Non-registered investment accounts, registered retirement savings plans, and other investment vehicles also play important roles in any financial strategy. The key is to create a diversified portfolio that balances risk and rewards while taking advantage of available tax benefits. So how does life insurance as an investment strategy compare to a TFSA? The key difference is the contribution limit. TFSAs have limited contribution room, whereas whole life insurance policies do not have a limit. Additionally, TFSAs are subject to market fluctuation, which can impact your value of investment. Whole life insurance policies, on the other hand, provide a guaranteed minimum return, which can be beneficial for those looking for a more stable investment option. With TFSAs, you enjoy tax-free growth and withdrawals, which is fantastic for short-term savings goals. Whole life insurance, when structured properly, can offer tax-free growth and a tax-free death benefit, making it an attractive option for long-term wealth building and legacy planning. When it comes to liquidity, TFSA funds are immediately accessible, but withdrawing funds impacts your future contribution limits. On the other hand, whole life insurance allows you to take out loans against your cash value. However, you usually have to wait a few years for the cash value to build up in size. In terms of growth potential, the rate of return of a whole life policy is guaranteed, while TFSAs depend on performance of underlying investments. For conservative investors, the guaranteed returns of whole life insurance can be appealing, but for those willing to take more risk, TFSAs can potentially yield higher returns, depending on market performance. Now let's discuss some potential pitfalls of both options. With whole life insurance, there's a significant commitment involved. Premium payments typically span 10 to 20 years, and if you stop paying premiums, you risk jeopardizing your cash value and death benefit. It's important to understand the terms of your policy fully. Some advisors may not structure your policy in a way that maximizes your cash value or investment potential, which can lead to disappointment down the line. Always do your research and consider working with a financial advisor that specializes in life insurance. On the other hand, while TFSAs are straightforward, they do have limitations. The contribution limits can restrict those who want to save aggressively for retirement or other financial goals. What's more, if you withdraw funds from your TFSA, it affects your future contribution room, which could affect your ability to save in the long run. Additionally, while TFSAs allow for tax-free growth, they are subject to market fluctuations, meaning your investments can lose value. Therefore, having a clear investment strategy is essential. Now let's talk about how you can maximize your wealth with both strategies. When considering whole life, think of it as a part of a broader financial plan. The cash value can serve as a safety net during retirement or as collateral for loans to fund investments in real estate or business ventures. This dual functionality makes it a powerful tool for wealth building, especially for high-income individuals. You might even consider leveraging your policy to invest in other opportunities, provided you understand the risks involved. Working with a knowledgeable insurance advisor like Dundas Life can help you navigate these waters effectively. So, how can you use life insurance and TFSAs together to maximize your financial wealth? One strategy is to use a TFSA for short-term savings goals, such as paying down a house or a vacation. Meanwhile, you can use a whole life policy for long-term investment strategies, providing a guaranteed minimum return and tax-free growth. It's also important to consider the tax implications of using life insurance and TFSAs. With a TFSA, the growth within the account is tax-free, but the contributions are not tax-deductible. With a whole life insurance policy, the cash surrender value grows tax-free and the death benefit is tax-free to your beneficiaries. To summarize, both whole life insurance and TFSAs serve different financial purposes, but can complement each other. TFSAs offer flexibility and tax-free savings, while whole life provides long-term growth and life insurance coverage. If you're aiming for high-risk, high-reward investment options up to $7,000 to $7,500 per year, TFSAs might be the way to go. However, if you want stable, long-term wealth building with tax-free benefits and unlimited contribution potential, whole life insurance could be your best bet. It's important to assess your financial situation, risk tolerance, and long-term goals before making a decision. The earlier you start, the more you'll benefit from these strategies. Don't wait. Click the link in the description to book a call with a Dundas Life licensed advisor and take control of your financial future today. Thank you for watching. If you enjoyed the video, don't forget to like and subscribe to our channel. I look forward to seeing you on the next one.